After 5 years and hundreds of trades, I've discovered that every massive stock winner like Nvidia's 200% move follows these three exact patterns that most traders completely miss. 1. They must be in a favorable market. 2. They are in a strong industry or sector. 3. They have a good technical pattern. Today I'm revealing 3 stocks showing these exact same signals right now, and I'll show you precisely why their setups look so promising and give you the exact entry and exit points to maximize your potential profits. Everything I will talk about is summarized on the Profit Punch website. So if you want the complete system that finds winners like Nvidia, which did 200%, Appfolio 350%, SMCI 250%, using just 1 hour of your time every week, you can find the full guide linked in the description below. I know the USA stock market is in a bear market right now, but the China market is very bullish at the moment. There are some stocks in the USA market which are really Chinese companies, and they hold stock in the Chinese companies on the China stock market. So when you buy the stocks on the USA stock market, their movement will mirror what is happening on the China stock market. And the first stock is YUMC. So remember our rules: strong market, strong sector, strong technical pattern. Here we have the daily chart, here we have the weekly chart. On the weekly chart, we have the 10-week and the 30-week simple moving averages. On the daily chart, we have the 20 exponential moving average and the 50 simple moving average. These are the only averages you need in order to understand how the price is moving. So if we look at what the stock did before, we can see this very, very tight price action, and the stock went up 48%. But what is interesting about this YUMC stock is that despite the fact that it went up over 50%, your risk was only going to be about 2.53%. So that means that you could make almost 20 times your risk back. So if you risk $100, you're making $2,000. That's what is very good about such trades. And I'm seeing it doing the same thing. When we look at the weekly chart, we like to see very big consolidation. So this consolidation has taken over 22 weeks and it's looking good. So now we can go into the daily chart and focus in on there. So we see this movement up and the stock is failing to break out this whole time. So here we do get a breakout and it's on volume. I color code my bars. So if you see such a dark green bar, that means that had some really good volume. What I like about this trade is that your risk can be very small. What we like to see is a very big base. We have a very big base, and then we like to see a virtual contraction pattern. So the first time it comes here, it contracts 15%. Then it contracts 8%. So I thought it was going to jump out. So I first initially bought it here and it didn't just move. So I've been holding it for a while. So it consolidated again, and this time it just did a 4% consolidation. So you see, when the contractions get smaller and smaller and it jumps out of that contraction like here, that's when you get these really big moves. For this trade, my plan would be to just buy it here immediately. Once the stock jumps out like this of a chit, you don't want it to come back into the chit. So if it comes back, I know something is wrong. So I don't want it to fill this gap that it did. So my risk, I think, is going to be just about 3.3%. And then what I would do is that after it has moved about 7% in my favor, I would sell a fifth of it. The reason why I like to do this is because when you sell a little bit and then it comes back, then you don't lose everything. So it just helps you stay in the trade and stay sane. And then since it's coming out of a very, very big base, like this is a very nice setup, I'll just hold it until it closes under the 20-day exponential simple moving average, since the Chinese market is bullish. The next stock that I really like from China is ATAT. This is a very, very good stock because the China market is synced with this stock. So you can see that when they were breaking out, they all had this move within the same time. So this happened on about 30th August. Then if we look at YUMC, I'm sure that breakout was about the same time. So yeah, around this time, you can see all stocks did that move. Why? Because the China stock market was moving. So the task is to find the strongest stocks in that market. That's the task of this video. So ATAT, very nice move. As soon as it gapped up on earnings, it went up about 64%. How much could you have risked? I don't want it to come back and close this gap. I don't think I would have bought this one because this consolidation was very, very huge and I didn't like it. It was more of a surprise move, so I wouldn't have bought it. But if I had, I would have risked only about 3% to make a 65% possible move. Of course, I don't think I would hold it till there. I would have waited for it to come back and I would have sold here once it failed under the 20-day about 50%, 43% risk. So about 15 times your money back. And then what are we seeing today? We see, if we go to the weekly chart, we always like to see the weekly chart. So this one is at all-time highs. All-time highs is a very good sign. There are no angry buyers waiting to dump the stock. And also, some of the biggest moves are from stocks, which are young companies. This is clearly a young company. So it's coming up here, forms this nice big base here. If we measure the time of the base, it's about 18 weeks. Very good. Anything above 16 weeks is a very good base, and it normally runs for a while. So when it broke out, what happened? I was very excited the first day. It broke out here. You see this very green bar, color-coded to mean that the volume is good, because it kept trying. Before we go into the breakout, let me show you the nature of the base. So we see a virtual contraction pattern. So we see a contraction here, contraction again. These are very good signs. And then it breaks out. First contraction, they do take their time, 17%. Second contraction is about 13%. Third contraction is about 9%. So when it broke out here, I was very excited, jumped in immediately, and then it came back. That's why I was telling you that as soon as it moves a little bit, I will take a fifth of my position off. I don't want to take off a very large position because I want to hold it for a while, right? So that's why I only take a fifth off. So if it comes back here, it's doing a reset. Because whenever a stock breaks out, three things can happen. It can go immediately, like it did here. It can come back and do a reset, which is what we are seeing, or it could just fail. So a reset is option number 2, which will happen sometimes. So it has come and reset, and just as expected, it has just come back to the breakout level. Because once we breakout normally turns into support. This is basic technical analysis. What I like about this setup is if you look very closely at these candles, this low here took out these lows. It's a very good sign. So as soon as it recovered here, I bought here very early in the morning on this bar. So if you want to get into this stock, again, like I said, I don't want it to come back and fill that gap. Very good stocks, they just go. They don't stay behind and think about things. They just go. That's why I normally risk very small. So for this one, I would probably only risk about 4%, right? I don't want it to come back and fill the gap. Risk is going to be about 0.4% of my account because I bought it here. So I'm only risking just this 3%. And then what I would do is as soon as it moves about 7%, take a fifth off, and then I'll just wait for it to close under the 10-day simple moving average. If it does a very nice move like this one and does maybe a 60% move, then that would be a very good return. So we're risking 3% to get 17 times our money back. So if you risk $100, you get $1,700 back. If you risk $1,000, you get $17,000 back. That's the beauty of finding stocks which have very good setups. This is a very nice setup. The base is not very big. Breaks out, returns, strong Chinese market. It's a buy. Then the last one is my third choice. I don't like this one very much. I picked it because it had a very nice prior strong move. So around that time, remember 30th August. So you see all of these stocks were moving around that time. So this one took its time because the other started moving about 6th September. This one waited a while and then it jumped up on this day, right? So it gapped up about 9%. So these gap ups are always very good opportunities to enter stocks. A lot of people are busy and they might not be able to catch them, but they are great opportunities. So after this gap up, it went up about 250%. So what should you have done in this past situation? So on these gap ups, I know that I don't want it to come back and fill the gap. If it comes back and fills the gap, then that means that it is not what I was looking for. You could risk the full gap, but sometimes it's too wide. I'll just risk about, what I normally get is the 1.5 average true range. And for the day before it was 0.26, I get about half of that. So this one I would risk about 3.6%. And then the maximum possible profit would have been 68 times your risk back. So if you risk $100, you get $6,800. I don't think you're going to be selling at the top here. I'd have sold after it gaps down on this very big day. So I'd probably just get about 36 times the risk back. So if you risk $100, you get $3,600 back, which is still a very good profit. And then we're seeing very similar thing here. So what I don't like about this one is that I can see it's trying to form a virtual contraction pattern. So it goes down 58%, then goes down 33%, then goes down 25%. So that means it's most likely this might not be the final contraction, because the last contraction, the very small handle that you like to see, is normally just maybe 3 times the average true range. So I'm looking for something which is maybe just about 20%. Anyway, what I would do for this one, I would just think of it more as a swing trade. I would buy if the price moves above the high of that candle. My risk would just be below the low of that candle, because these confirmation candles, you don't want the price to move below it. That's the other thing. So for those gap ups, you don't want it to come back and fill the price. But for this is what I call a confirmation candle. You want the price to go immediately above it, and once it goes above that candle, you don't want it to come back down. If it comes back down, something fishy is happening. That's very tight risk. That's very tight risk management. For some people, they might not like it, but I don't like to lose money, so I try to put this very tight risk. So I would probably just put my stop there for 0.5 risk, and I don't know where this one would go. That's a problem, because it's not at all-time highs. There's very looming sellers who bought here, and they would be willing to just sell the stock once it recovers to that price. So I'm not quite sure. This one would be more of a swing trade, but the first two, I think they have perfect setups. And this one also has earnings, which is not a very good sign, because earnings could go up, could go down. It's a gamble. So I'd probably stay out of this one, but if I had an option, I would swing it. I'd stick to the first two. If you liked what is in this video, subscribe to the channel, and sure to get the complete guide from the newsletter, which is linked in the description, and may the markets be with you.